Petya is Deputy Director in the IMF's Research Department with responsibilities for overseeing and pulling together the WEO. As one of the fund's longstanding and leading economists, despite her youth, she's held prominent positions in the fund's strategic policy and review and European departments. Fabio is Deputy Director in the fund's Monetary and Capital Markets Department. He's responsible for overseeing and pulling together the GFSR. He's had a long distinguished career at Fed and the Treasury before joining the IMF in his current capacity. I'll give each about 12 minutes to provide an overview of the WEO and the GFSR. I may put a brief question to you afterwards. I'll then turn to the audience. To kick off the audience discussion, I've asked Jean-Maria Malesi-Ferretti to kick us off. Jean-Maria worked at the fund for many years and was Petya's predecessor, so Petya is going to have to be on her toes today. Audience questions can be submitted via the chat function. I may just call on you directly. So, Petya, please kick us off.
Thank you very much, Mark, and it's always a pleasure to be here to be presenting the highlights of the World Economic Outlook, which we released just a few weeks ago. And while I'm waiting for the slides to show up, maybe I should just say that this has been one of those really we had to scrap it and start from scratch, basically, given the developments that we saw, given Russia's invasion of Ukraine and the sanctions and everything else that happened. So with that, if we can go to the first slide. So this is the summary of the World Economic Outlook, that we're seeing a global economy, global recovery that has been shaken by a war. And the main themes that emerge in our report are the war, the repercussions of it, inflation, and debt. So we are seeing, what we've seen is a major supply shock, which has a slowing growth and is producing higher inflation. And you can see that through just a couple of charts that it shows you the growth path that we now have as opposed to what we had just a few months ago in January. So we've revised down our forecast for global growth by 0.8, and it's now 3.6 this year, again, and also 3.6 in the coming year. Now, the major shock, again, what's produced this has been the war in Ukraine. And if you see the decomposition of that revision that I mentioned, the 0.8, where it's coming from, basically close to half of the downward revision comes from lower growth in Ukraine and Russia, as well as the repercussions of that, the direct impact of that through commodity channels, but also through confidence, financial channels and others on the rest of the world, and most importantly on the European countries. So you see in red the sizable downward revision that we have in euro area growth. Now, the rest of the downgrade comes from all other countries, but more prominently the US, where the faster pace of monetary tightening is the main reason behind the downgrade. And then, of course, China, where the interaction with the Omicron wave, with the COVID strategy, zero COVID strategy, and the dampening impact of that on consumption has been one of the main reasons behind the downgrade. At the same time, you see in the middle chart the much higher inflation path that we have. We've seen further pressures from commodity prices. At the same time, we've seen the impact of this imbalance between demand and supply still playing out much more prominently than we had anticipated, which is producing these much inflation inflation rates. Now, when it comes to just thinking about the risks to the outlook, they're very much on the downside, and we feature and we talk a lot about the possibility of the escalation of the war and the sanctions, which could lead to further disruptions in commodity prices, supply chains, refugee crisis, possible social unrest. And especially if you think about, again, the channel through commodity prices and the impact of that on headline inflation, another related risk is to have de-anchoring of inflation expectations. And that would, again, put further pressure on the global economy through higher interest rates and the possibility of much worse debt problems. Now, of course, we shouldn't forget about COVID, and it's still circulating, and it's still, we're seeing the situation in China. So we cannot exclude the possibility of new variants. So the bottom line, the list of risks, downside risks, which is typically on the longer side, is even longer this time around, and there are not that many upsides at this stage that we see. Now, the recommendations, the policy recommendations are, I guess the first one is the most common sense one, which is that what can really help the most is ending the war. I guess that would fall under the multilateral cooperation, how critical it is, and this is one aspect of it. But when it comes to national policies, and we spent a lot of the real estate in the chapter talking about monetary policy, the importance of calibrating it in order to fight inflation and to really make sure that there's no, running away inflation expectations and de-anchoring, which would make things even worse. Also, on the fiscal side, we recognize that the major shock that has occurred has also put further pressure on already vulnerable segments of societies and also of countries, where the higher prices, especially high food prices, would call for very targeted support to those who need it. But given the already elevated debt levels, I think our main message on fiscal is basically also the importance of replenishing some of the fiscal buffers over the medium term. And just to wrap up on the policy side on multilateral cooperation, beyond ending the war, of course, there are issues related to debt, the common framework, making sure that the frameworks are ready for potential debt issues. Then there's of course the looming climate issue. And last but not least, which is a theme that is now emerged, is the question of the issue of fragmentation. How do we avoid a permanent fragmentation across different blocks, and what would be the repercussions of that? So this is one of the themes that we just point to, but we don't develop further. I guess it's for further reports. Now, so this is kind of a summary of the wheel. If I run out of time, I think this is what I want to leave you with. But now I have a couple of slides to illustrate some of the points. If we can move to the next slide, please. So this just shows the medium-term outlook, what it looks like, and you'll see that essentially what's happening is that the recovery to the pre-crisis trends has been delayed by this shock in advanced economies. And then when it comes to emerging and developing countries, the gap grows even larger, or it stays as large as it was before. At the same time, we see the increase in debt levels, which is putting a lot of pressure and making it more difficult, especially when we look at the interest payments to revenue, which is like one measure to kind of see what that fiscal pressure is going to look like. And there, it's again low-income countries that are faced with potentially the most difficult situation there. Can I have the next slide, please? This is just a slide to illustrate the extent of the surprises, the inflation surprises that we've seen so far, and how broad-based they are across countries. The chart on the left just shows you that there are really very few countries where we've not been surprised on the upside in inflation, and these are mostly countries in Asia. Now, these surprises have not just been on the headline, though, they're also on core inflation. And we have seen elevated levels of core inflation as well in many countries, I would say in most countries, again, with few exceptions there, a lot of them, again, being in Asia. Now, one of the, beyond the commodity prices, of course, the other aspect of this has been driving force behind the high inflation rate has been the supply-demand mismatches. And, we are expecting those to wane, although unfortunately in the most recent data don't necessarily point in that direction. And we don't expect those to fully phase out until 2023. Can I have the next slide, please? So turning now to some of the policy challenges, I would say one of the main ones is combating inflation. And did just a few charts to illustrate the magnitude of the problem. The chart on the left just shows you the dot plot for the US, and then some estimates of the short run neutral nominal rate. And I think what we're trying to say here is that a lot of things have to go right in terms of bringing inflation down in order for these forecasts that we put forward to materialize. Meaning the rotation from goods to services and the accompanying pressures on the supplies, on the supply-demand mismatches would have to work in a good direction. Also, the commodity price on a forward-looking basis would have to come down, which is what we have in our forecast. But really, the monetary policy stance as such is, at least under current projections, is not contributing that much in order to have that decline in inflation, which is another way of saying that the risks to the inflation forecasts are very much on the upside. And we have seen long-run inflation expectations, which is the heat map in the middle, turning in a not very good direction. I think we're still talking about largely anchored inflation expectations, but I think we are seeing some drifting away from the targets in a number of countries. And the concern is that if there were to be further surprises, for the surprise tightening of U.S. monetary policy in particular, and tightening of financial conditions globally, that would put further pressure, especially on emerging markets and developing economies. Can I have the next slide, please? So the other policy challenge is, again, managing the vulnerabilities in emerging and low-income countries. We have seen the higher food prices and the pressure that we're likely to see on fiscal accounts through higher subsidies. That is also being reflected in markets assessments of the of spreads and such. And more generally, we are expecting to see elevated external growth financing needs. And here, the big differentiating factor for us has been whether you're a commodity importer or exporter. By the way, I should have said that at the start. The very few countries where we've had upward revisions have been commodity exporters. And if I can have the last slide, please. This is just to say that, again, we still have COVID going on in the background, and we're still in a situation where only 50% of the people over 75 in China are vaccinated, although that number keeps changing day by day. So there are sizable risks in our forecast, especially those in terms of the impact of COVID and supply chains in China. We still have all of the issues in the low-income countries in terms of the relatively low vaccination rates. So what we've really called for is a more comprehensive approach at this stage to tackle the crisis. I will stop here because I think I'm out of my 12 minutes. Thank you.
Well, Petra, before turning it over to Fabio, did you want to give us a minute's thumbnail sketch on the other analytic chapters so that the audience is mindful of them?
Sure. Thank you. Thank you for that opportunity, Mark. So we've had three analytical chapters, two analytical chapters and a spillover chapter this time around. The first one is about private debt and where we stand in that, and because we have seen a very elevated levels with a lot of differentiation across countries. And the bottom line there is that we do expect those levels of relatively high levels of debt to be a drag on the macroeconomic recovery in the years ahead. The second chapter was about green jobs, just even thinking about what is a green job, how do we transition in and out of it, what are the policies that would facilitate that transition. And then the last chapter, the spillover chapter, it was about trade and supply chains during the pandemic. And what we find there is that in some ways supply chains have actually been remarkably resilient during the pandemic, and going forward, what makes sense is to actually diversify rather than reverting back to not trading and kind of having very limited diversification. So I'll stop here. Thank you.
Thank you. Fabio, over to you.
Thank you, Mark. And first of all, thank you for the invitation. It's always a pleasure to be here. Start feeling like home a little bit. So thanks again for inviting us. So I'm going to try to give the financial market version side of what Teddy has covered in terms of both how we see market pricing, uncertainty about the outlook, as well as possible risk as they relate primarily to inflation outlook and monetary policy. So if you can move to the next slide. This is going to be the summary slides in some sense of what we try to do in the Global Financial Stability Report. The chart to the left focus on financial conditions. We produce these indices in-house, and so you can see there is a significant tightening of financial conditions, broadly speaking. Now, this is true more prominently for Central, Eastern, Southern Europe, right? This is the vicinity, obviously, to the conflict. We have seen significant tightening of monetary policy, decline in asset prices, but it's also a broad tightening in advanced economies as well, right? So if you look at the US and the Euro area, you see the direction of travel of financial condition, it's one of tightening. Now, the point I want to make here, though, is that in terms of levels, these financial condition indices are still below the zero line, which means, generally speaking, conditions are still accommodated. And so the big question for central banks is this enough removal of accommodation to achieve a soft landing and brings inflation credibly down to targets? I think this is, if I had to pick one question to summarize the challenge they face, is this. In some sense, the tightening of financial condition is the intended objective of policy, right? So there's not much central bank can do on the supply side, whether this is through commodity prices disruption, whether this is through an intensification of COVID cases in China, and so resurgence in supply side disruption. Monetary policy can't fix that. What monetary policy can do is to slow down aggregate demand if you want to slow down inflation, right? Inflationary pressure. And so the question is this tightening enough to manage this soft landing and brings inflation down from 40 years levels, record high level, down to target? Now, then what we do in the GFSR, we translate those financial conditions into a distribution of world GDP. And so if you look at the black line, that was the distribution of GDP as of the GFSR of October of last year. The red one is the distribution of global GDP as of this GFSR. And those are centered on the wheel. So the number of the forecast that Petya was discussing, this is where the distribution are essentially forced to be centered in terms of mode. And so the mode moved down 0 percentage points in line with the downgrade in the wheel. But what we're interested in here in terms of financial stability is the shape. And so you can see compared to the unconditional density, which is sort of like an historical density, that the shape is much larger, right? So there's much more uncertainty essentially around this mode. Not only that, but there's a left fat tail, which means there's a lot of downside risk. If you look at the square, the red square, that's the 5th percentile. Essentially, it says that there is a 5% probability that inflation is going to be somewhat below the zero line. The probability of growth negative, it's 8%. So in terms of historical percentile rank, you can see that we're starting to move again back toward the red zone here. So closer to where we were with COVID and the GFC. So clearly there's a lot of uncertainty in terms of the outlook. Next slide, please. Now, the focus, again, primarily part because it was a macro theme ahead of previously before the Russian invasion of Ukraine, but also because some of this commodity disruption actually exacerbated inflationary pressure. We've seen a significant increase in long-term rates, not just in the US, but across the board, generally speaking, advanced economies. Now, the common theme, I think, between US, Canada, and Australia is that the increase in rates has been primarily driven by real yields, right? That's the gray shaded area. Now, when you look at the euro area, it's a little different. Most of the increase is driven by inflation expectations, or for inflation break even, with the UK somewhat in the middle and Japan looking a little bit more like the euro area. So push up in inflation expectation, but real yields coming down. And again, the question is that increasing real yields or lack of thereof, increasing real yields enough to bring down inflationary pressure? If we look at market-based measure of inflation expectation or inflation break-even, you can see a significant increase in the 5-year forward inflation break-even, as you would expect, right? You have commodity price rising, you have strong demand. The part that is more concerning, I think, it's the increase in the 5-year forward. That is a sort of a proxy for inflation expectation in the long run, and those should be somewhat anchored around the long run inflation target. And so I think the word we use now is still largely anchor, but we can start seeing some signs of this inflation expectation, long-term inflation expectation starting to move up. Next slide, please. Now, what does it mean? It means that, of course, markets are pricing in a significant tightening of monetary policy, right? So if you look up from the end of 2001, which is the green line, pre-invasion, to where we are today, the red line, there's been a significant increase in the market expected implied path of monetary policy. Not just the Fed, but also ECB, Bank of England, and interestingly, also the Bank of Japan. Now, of course, you need to be mindful of the levels. The y-axis is different, right? So Bank of Japan, we're still talking about 40 basis points. The Fed, we're talking about almost 3.5% terminal rate. The other commonality here also is that in some sense, it's like the shape of this path, right? At some point, markets are starting to price in an easing of monetary policy, sometimes toward the end of next year or 2024, both in the US and in the UK. That means market pricing in some sort of easing of monetary policy, perhaps in expectation that the Fed will not manage a soft landing, and they're trying to achieve now. Now, as next slide. Now, another way to look at this is to look how accommodated monetary policy is. And so if you can shift to the next slide, what I was going to show is, and this is based on the forecast of the SCP that the Fed put out in March, right? So the green is the market projection for the median dots in December of last year. The red one is the median dots as of this year. The solid, dash blue line or light blue line is the terminal rate, the neutral federal fund rate. So you can see clearly that the median market FMC participants has moved up the path of policy quite a bit. And in fact, they're going above the long-term neutral federal fund rate. Now, markets are much higher than that, and have continued to move that up. There are about 10 hikes pricing for now, for the end of the year. And so the question is, one of the two will have to converge, right? Either markets will have to come down to the Fed, or the Fed will have to move up to markets at some point to get some resolution of this. The part that is more interesting, though, it's in terms of real rates, right? So if you take essentially the red circle, you subtract the median PCE, so to make it consistent, internally consistent, they come out with some sort of like median internally consistent real federal fund rate. You can see for both 2022, particularly for 2022, we are still at 250 basis point negative real federal fund rate based on the projection in March. And even by end of 2023, we are barely at zero. Now, so the question again is this sort of tightening? And of course, they will update this in June with the new SCP. There's going to be a decision by the committee tomorrow. But is this sort of tightening enough to slow down and cool down inflation? I think that's the bigger question in the market. The market are kind of teasing the Fed in some sense, right? To see what is the response of the Fed and trying to push rates higher. What is the reaction factor, essentially? Both with the new framework as well as the quantitative tightening that we'll have to announce. Next slide, please. Now, briefly, I'm going to try to pick up pace for a second. Now, one question was like, what's happening with long-term rates, right? And this relates to the point of the quantitative tightening. So what I'm showing here to the left is the federal fund rate, the actual federal fund rate, the 3-month rate 2 years from now, some sort of measure where policy rate will be. That's the black line, and the 5-year forward rate. the yellow line. The point trying to make is that, yes, at least at the time of the GFSR, long-term rates in the US were lower than one might have expected. But once the normalization of policy rate commenced, then usually long-term rates pick up. This has been a consistent pattern over the past few tightening cycles. And you can see right now too, right? The five-year rate, the yellow line, is starting to pick up quite significantly with long-term rates moving higher. Now, so the question is, how much will they move up? Will this be gradual, or will it be disorderly? Now, our estimate is once they start removing quantitative, once they start removing QE, and so shrink the balance sheet, which is almost double compared to pre-COVID, our estimate is about for 50, 60 basis points in terms of real rates. That is not a tiny number, if you want, right? And so can they manage to do this in a gradual way that avoid disorderly tightening of financial conditions? I don't have time to focus on this because at this point it's less relevant, but at least a couple of weeks ago, there was a lot of focus on the inversion of the yield curve, right? What the yield curve was telling us in terms of probability of recession. And maybe we can come back to this. I want to close briefly with a couple of words on emerging markets and the tightening cycle. So the last two slides I have here. Okay, one is about the inflation expectation. So based at least on of what we see in terms of deviation inflation for target, you could see the markets are investors are expecting inflation to come back toward targets. Now, those are forecasts. There's clear differentiation between, say, Latin America and Eastern Europe vis-a-vis Asia, right? So that's one differentiation channel in emerging markets. The other one being vicinity of the war, obviously you are more affected. And third one is along commodity markets, right? Whether you are an exporter or an importer. And you can see also in the path, the market implied policy rate here. Latin America, Central Europe, they've started tightening since last year. The policy path has moved up, but it's much higher in terms of level. And in fact, it's starting to price in some easing over the next few years. Asia, because inflationary pressure have been less evident and inflation is slower, markets are starting to price up now a tightening of the policy rate. But you can see the slope of the curve is still relatively shallow. So clearly one important differentiation geographically between emerging markets. Then next slide. You can go forward after that. I believe I had another slide very quickly on emerging markets.
This is the last slide on the document that I was sent.
So, but anyway, the point is that I'm just going to say it works. Then, of course, that tightening of financial conditions is starting to have an impact on emerging markets, both in terms of capital flows. We've seen significant outflows, for example, in our currency, particularly in China, and I can come back to this. Also start seeing a tightening of financial conditions and a significant slowdown in issuance, both in sovereign issuance as well as in corporate. So clearly the external costs are going up for emerging markets, and clearly you start seeing some pressure. Some markets, some countries actually have front-loaded monetary policy tightening, and perhaps they have more breathing space. But the distinguished line that seems to be at this point between commodity exporter and commodity importer. And I'll stop here, Mark.
Great. Fabio, would you, as I offered, Petya, would you like 1 minute to tell us what's in the other analytic chapters?
Yeah, so we had two chapters. One was on the bank sovereign nexus in emerging markets. I think that's an important point coming out of COVID. Of course, when we start thinking of this, it was with an eye primarily on COVID and what was the implication of COVID for public finance and the fiscal condition of emerging markets. Now, of course, the war in Ukraine, the Russian invasion of Ukraine has a little bit changed that, but I think the focus on that topic and the transmission channel through which could become problematic, right? In terms of holdings, in terms of safety net, and in terms of the macroeconomic feedback. So I think it's still valid despite the change in terms of geopolitical focus. And then the last chapter has been on the rapid growth of fintech. So we focus on vulnerabilities, opportunities in the growth of fintech, particularly with online banking, so neobanks, with an eye on online mortgage originator in the US. That's a very interesting case studies, as well as DeFi, so decentralized financing, what opportunities and risk in terms of financial stability comes with that, and policy recommendations.
Good. Let me ask one question before moving on to the audience. So your presentations understandably focused quite a bit on inflation, advanced economies. I think as you both noted, though, China is facing a raft of issues. There's COVID, there's lockdowns, there's housing, higher energy prices. I assume that the WEO forecast already slashed China's growth outlook, but I assume that you locked down the assumptions for the China forecasts before a lot of the problems have deteriorated. So, Petya, are the downside risks piling up for the fund's China forecast? And Fabio, could you assess contagion risk from the housing sector? And then just one last quick thing for Petya. So basically, annual average forecasts can mask a lot of momentum issues, right? Because of the statistical carryover, which should be fairly robust this year. I've seen your 4th over 4th estimate. It's rather different than your annual average forecast, much more so than usual. Can you say something just about how you see momentum in 2022 as opposed to the annual average? So Petya, I'll start with you.
Okay, thank you. So on the China forecast, I think the way I would characterize it, that we still felt comfortable with the China forecast, even as we were presenting the numbers 2 weeks ago. However, with a big however, that forecast even then and now is subject to sizable downside risks. And here, the way our team thinks about it is that, we see the lockdowns, and the longer they last and the more they spread across the country, then the bigger the downside risks. And at some point that would lead, if that were to continue, it would lead to a further downgrade in the forecast. The other thing to say on this is that we've seen policy measures from China, again, in the last few weeks. And in our view, they're not sufficient. And I think more would need to be done, especially on the fiscal side, in terms of providing support to households in order to address or to help with the current situation. So that's on China. Now on the forecast and the Q4, I'm really glad you're bringing this up, because as you know, most people who know what the numbers mean to go directly to the Q4 over Q4 numbers. They're just more difficult to explain to the broader public. But this is where we have significantly lower numbers. So Q4 for 2022. We are now at 2.5, which is a downward revision of 1.4 relative to where we were in January. And all of this is to say that, there's a really sizable carryover, but the momentum itself is not very strong. And in a way, we're already seeing the deceleration in Q1. We've seen downward surprises in most of the countries for which we've seen data, with the notable exception of Mexico, where we've seen an upward surprise. And more generally, we're also seeing retail sales and consumer confidence pointing to softening in global consumption as we go into Q2. So I'll stop here. Thanks.
Great, Fabio.
So maybe picking up what Petya left in terms of China, right? So one way to think about downside risk, I think we can do it 2 ways. One is like what markets are pricing. So one cheap way to do is to look at the equity market, right? So if I look at the performance of equity market year to date, we have the US and Europe down about 13%, Japan doing much better, emerging markets, same line, China is down almost 20% in terms of equity valuation. And that must reflect not just some issue related to uncertainty about the regulatory environment, particularly on the tech side, and the tightening of some of the regulatory environment, but also in terms of the clear deterioration in the outlook for the property development sector, as well as the broader economy, particularly as they relate to resurgence of COVID. So that's one way to look at it, and also relatedly, capital outflows from China. In terms of how this could play out, we have seen, again, a deterioration in the property developer sectors. There are more than $200 billion outstanding issued by these companies, and deterioration is seem to be spreading beyond also the sector, right? So to other corporates as well. And so you can imagine a situation where this deterioration starts having implication for the broader housing market. You see housing sales down, decline in house prices. And then from there, it's sort of like the transmission channel could go from there to local governments, land sales an important sort of revenues for local governments. And so pressure are more evident for the local governments are more like weak from a finance perspective, from a public finance perspective. Now, local government play an important role in terms of, for example, providing support to corporates in their area, as well as the relationship and the link then from those corporates to banks. So you can see how you can quickly go from property developer to housing to local governments. And then if banks are curtailing lending because of deterioration in risk appetite and expectation of losses, then you can get what becomes more concerningly become a macro shock, right? You can start getting like a cutting of credit provision to the economy. And on top of those, some of the supply side disruption that we had discussed before. So now, as Petya said, authorities have taken steps, both from the PBOC side in terms of easing monetary policy, in terms of the fiscal policy. I think what we would like to see more is more action at the central level, particularly in terms of fiscal policy. Clearly, the outlook has deteriorated, and if anything, conditions in that sector have gotten worse since the last GFSR, if not easier.
Thank you. So Petya and Fabio, thank you for your fantastic presentations and your answer to my question.